Hello, everyone. Joe Anderson here, President of Pure Financial Advisors. Want to thank everyone for joining us on another WebEx or webinar. Today, we're getting into long-term care solutions. Like I said, my name is Joe Anderson, President here of Pure Financial Advisors. Again, thank you, everyone, for joining us. We're doing quite a bit of these education workshops. So go to our website at purefinancial.com if you've missed any of the previous WebEx or webinars that we have done. What I want to get into is something pretty serious. When it comes to aging, right, we're all getting older. You got 10,000 baby boomers turning 65 every single day for the next roughly 13, 14 years. And here's a pretty scary statistic, is that 70% of Americans turning 65 will need some form of long-term care some point in their lives. But it's not necessarily what you think. It's not illness. If you take a look, is that accidents, right? We're falling down, we're getting older, we're breaking hips, breaking legs, and things like that will need some sort of long-term care, some rehabilitation. So yes, there's still a lot of individuals in a long-term care facility that has dementia, Alzheimer's, things like that. But also we need to recoup of our aging bodies when it comes to accidents, falling downs and things of that nature. Who's going to care give? If you're watching this presentation with your spouse, just look to the right or left of you. In most cases, the caregiver is the spouse, or it could be a family member, right? But if you have a plan in place, the stress decreases significantly. So that's what I really want to get into, is what type of plan are you going to have in place in case one of you or both of you go and need some sort of long-term care. So what is long-term care and who's going to need it? Well, what is the average cost of long-term care? What are your options? And then we can get into choosing a long-term care policy if you choose to, and how to keep long-term care affordable. And then we'll look at some hybrid life and long-term care policies that are fairly, well, I wouldn't say new, but they're a lot more popular because there could be some affordability there. Now, what is long-term care? All right, so it's not necessarily long-term care insurance is what I'm referring to here. It is we'll need some sort of care. 70% of us will need some sort of care. So that could be home care, someone coming in, maybe just doing the dishes, cleaning up, helping with medications, assisted living, adult daycare, respite care. Respite care means, all right, well, here, maybe you have a caregiver, that's your spouse. They need a break. You can bring someone in to help them get a little respite. Nursing home stays, of course, and Alzheimer's care. That's long-term care, all right? So it could be a number of these. It could be one. Whatever, just understand that, again, a lot of us will need some sort of care in the future. So what triggers this? Well, maybe we have trouble bathing. Maybe it's dressing or eating, transferring, using the toilet, continent. These are activities of daily living. Now, if a couple of these we cannot do, that's when long-term care, if you have long-term care insurance, will kick in. But think about it. I mean, if you've ever hurt yourself just trying to I threw my back out, just trying to put my socks on was, an accomplishment in itself. And so if you have some sort of need or care, look at these. This is the activities of daily living. This is what brings into long-term care. So who's going to need it? Well, we just talked about the statistics, right? If you look at insurance here, 70% of us will need some sort of long-term care. 25% of us get in a car accident, 25%, right, our house is burned down, but 70% of us will need some sort of long-term care, and this is by the U.S. Department of Health and Human Sciences in AARP. So most of us will need some sort of care. Then you got to think, all right, well, how much is it going to cost? Well, here in California, nursing home is over $100,000 per year. Assisted living is $45,000, and this is by Genworth. This is a cost of care survey that they did. So $100,000 here in the good state of California. That's an average, right? So if you want to go to a nicer facility, of course, those numbers are going to increase. Now, how much will you need? Well, on average, now these are averages. Women will need an average of about 3.7 years of care. Men need an average of 2.2 years. 20% of people, though, will need care for more than 5 years. So if you look at the averages, right, some of us will go in and potentially pass away within a couple of months. But then you have like Christopher Reeve. He needed care for many, many, many years. So it really depends, of course, on genes and what's going to happen. But on average, so we take a look at these averages to figure out exactly, okay, well, how much is this going to cost us? So if I have 3 years and it's going to cost me $100,000 a year in nursing home, well, that's $300,000 that I would need to set aside to make sure that I can potentially care for myself. And here's another thing. When you're looking at long-term care, right, you're not necessarily purchasing it for yourself, you're purchasing it for your spouse in a sense, because your spouse is probably healthy, you need the care. All of a sudden you're draining $100,000 a year through the nest egg. What is that going to do to the surviving spouse? So what are your options here? Do you want to buy insurance, transfer this risk to an insurance company, or should you self-insure, right? A lot of you by default are self-insuring. Maybe you think, all right, well, here, I have a lot of equity in my home. Hey, I've saved a lot of money. We can just tap into that. Or some of you might want to protect the assets and look for a long-term care policy. Now, just full transparency here. I am not an insurance agent. I do not have an insurance license. I do not sell long-term care life insurance. However, I do know quite a bit about it because I've been in the business close to 20 years. A lot of our clients, as you know, are in retirement, close to retirement. And some instances, people will need some sort of care. So our job as financial advisors and financial planners here, Pure Financial Advisors, is really to come up with a strategy to figure out exactly what is going to be the best option for you. Should you self-insure it, or should you transfer the risk to an insurance company? Now, who doesn't need this? All right, so if you're looking at long-term care insurance, if you have very little or no assets, all right, if you're disabled, right, or if you don't have any money to pay the premiums, right, so if you're going to go broke paying long-term care premiums, well, then it's probably not your best bet to look at transferring the risk. If you don't have any assets, all right, well, then that's going to be a MEDICARE type of position here. So we'll get into who's going to cover it. Some people think Medicare will cover it, right? Well, Medicare does not cover long-term care. It will cover a very small portion of long-term care. So it might cover a couple of days, depending. You need skilled nursing care, right? So what that means is that there's custodial care and then there's skilled care. So you have to take a look at, all right, well, is Medicare going to help me out? Well, if you're going to get better, sure, but if you're not, then no. All right, that's kind of vague, but a lot of times people think that Medicare is going to cover a long-term care stay. No, that is not the case at all. You want to look at, it covers skilled care. It will require, I think, a 3-day hospital stay. It will cover maybe the first 1 to 20 days. That's about it. And as we just looked at averages, the average is what, 2 to 3 years. Some of us will have to stay a lot longer than that. Then there's co-pays from years 21 to days 100. And then you have very limited choices. So Medicare is going to cover a fraction of it. So do you want to choose a long-term care policy? All right. Well, there's a lot of pros to looking at transferring the risk to an insurance company. You can protect your assets. You can protect your retirement funds. There's tax benefits because the benefit that you receive from a long-term care policy will be tax-free. For instance, let's say that you have a long-term care policy that you purchase now. And you get a 150, 200-day benefit, whatever that is, for the next 3 years. And let's say you don't need that policy until you're 85, maybe 20, 25 years from now. Most policies will have an inflation adjustment rider on it of, let's say, 5%. So that $150, $200 benefit that you're buying today, that's in today's dollar, that's going to increase. And let's just assume that once you need the care would be about $500,000 of care. Well, if you would have to pull that from your retirement account, you would probably have to pull up maybe close to $800,000 to net $500,000. So there's some huge benefits there because the benefits are tax-free. It's going to preserve your dignity, the standard of life. It's going to give you independence. It's going to give you choice. One of the biggest fears is being a burden on the family. So there's huge pros, to having that protection. The con, nothing's free in life, right? They're extremely expensive because everyone is using them. When you take a look at life insurance, right, so term life insurance, only a small percentage actually dies with a term life insurance policy, and that's called lapse, or you just get rid of the policy, or maybe it expires and you don't need it anymore because you just needed it for a certain period of time. Well, long-term care, everyone that purchased long-term care is keeping those policies. They're not lapsing. And the insurance companies mispriced these significantly when they first came out, so the cost of premiums are very, very expensive. And they're complex. There's a wide range of benefits, so you really have to do your due diligence here. If you're looking to transfer some, all, or part of this type of risk to an insurance company, you have to understand what you're purchasing. So you want to look at the limitations and the features of the overall policy. What type of care will this insurance policy cover? How long is that benefit? Do you want it for 1 year, 2 years, 3 years? What's the waiting period? That's kind of a deductible. So maybe that policy doesn't kick in for 30 days, 60 days, 90 days, 180 days. So then that's kind of a copay as well. So the longer you have that waiting period, that's more dollars coming out of your pocket to potentially, provide yourself with that care. So you're paying for that care before that waiting period kicks in. You want to make sure that it's renewable. And inflation protection, we all understand that the cost of health insurance or just health care itself increases higher than normal inflation. So you want to make sure that if I buy a $150 daily benefit today, I don't need that benefit today. I need it in 30 years from now, 20 years from now. You want to make sure that that $150 daily benefit will increase with inflation. So you want to make sure that you look at, is there inflation protection on it? Is it compound inflation? Is it simple? Are there waivers of premium once you actually have the policy pay out for you? So choosing the right type of long-term care policy really depends on a lot of different things. How much assets that you have? How much of those assets do you want to protect? Right? Do you have history in your family of Alzheimer's or dementia? So then you can say, all right, well, I might be a candidate to have some of this, so maybe I should protect the surviving spouse. Now, like I said, it's extremely expensive, so how do we keep it affordable? Well, of course, you want to buy it when you're younger, right? Because the younger that you purchase it, the lower your premiums are going to be. But of course, then you have to purchase those premiums. You're going to have to keep paying those premiums for a longer period of time. You have to understand the policy provisions. Please shop around. A lot of companies are getting out of the long-term care business because they can't afford it. Be careful there. You might be stuck with, all right, you might see some cheaper premiums, right? But then they might increase those premiums on you later on. And be flexible. So take a look and say, hey, you know what? I'm just going to transfer part of the risk to an insurance company. I'm going to use maybe my home equity for another part of this, and then I have some assets that I can potentially use as well. Have a plan in place, because the likelihood of it happening is fairly high, 70%, and it's extremely expensive. So you want to make sure, again, that you have a plan. It's not like, here, let's just transfer 100% of the risk to an insurance company. No, I mean, you can get creative in some of the planning that you're doing. Also, limit the terms will cut the cost of your overall long-term care policy premiums. So if I'm saying, hey, maybe I don't want to do 3 years, I'm just going to insure 2 years. I don't need a lifetime benefit. I'm just going to do 1 year. Well, I'm a guy, the average stay for men are 2.2 years. Maybe I just want to insure half of that, so I'm only going to get 1 year of coverage. Split the term with the spouse. They're getting a little bit creative now when it comes to long-term care policies, where you can dual the policy up with both spouses. So if one spouse needs it or the other spouse needs it, you can kind of split the term with the spouse and kind of have a joint policy there. Choose a longer elimination period. I talked about this briefly before, but say instead of saying the policy kicks in 60 days, I'm going to wait 180 days. That's my copay. I can pay out of pocket for 180 days, maybe a year, whatever. Again, it's just getting some creative planning going to look at your entire asset base and find out where those assets are. Again, if you're looking at, hey, if all my money's in a retirement account, remember all of those are going to be taxed at ordinary income rates. So if you have to pull out an additional $40,000 for home health care, $50,000 or $100,000 for nursing care, right? What's that going to do to your overall tax situation? For those of you that are clients of the firm, you know how tax sensitive we are when it comes to our planning. This is just another example of making sure that you're tax efficient in your overall strategy. Trying to stretch out that coverage as much as you can, and don't buy too much, right? You don't want to necessarily be over-insured here. Right? Hey, look at the averages. That's a good way to look at it, but we don't know. Right? I don't know how long, if I'm going to go into a facility, hopefully I'm only in there for a couple of days. Right? I don't want to be walking around, for years. Right? Hopefully it's a short stint, but we never know that. And spring for the inflation protection, I talked a little bit about that earlier too. Healthcare increases are higher than normal inflation. So you don't necessarily want to get stuck with a $150 day benefit or $200 day benefit or $300 day benefit in today's dollars when you don't potentially need that care for quite some time. Couple of websites for you, all right? NAIC.org. This will list companies in your state, all right? AALTCI.org. So these will list companies with strong credit ratings. Of course, you want to make sure that the credit worthiness of that insurance carrier is strong. When it comes to increasing premiums, so as some of you have policies, some of you might have heard other stories when it comes to people having long-term care policies, yes, that the insurance companies can increase those rates. They have to do it for a whole class of individuals. And they have to go to this insurance board and everything else. But as we're finding out, a lot of these companies mispriced them. They priced them basically like life insurance, which was a huge mistake for some of these actuaries. So just make sure that you have a high credit rating company. Take a look. Have they increased rates or premiums in the past? What does that look like? And then check joint policies or group policies offered through your employer as well. More and more employers are offering this type of benefit. There's pros and cons to that. I know some companies, they try to self-insure this long-term care, and those premiums went up about 80% because they didn't necessarily price it right. But if I can get through a group policy, right, those premiums, just like group life insurance, are going to potentially be a little bit cheaper. But anything that you do through your company, be careful there, because here's some stories that have happened in the past is that, let's say I have life insurance through my company. Maybe I get disabled first and then I die. Well, once I'm disabled, I'm not working. So I'm off the books of my employer, then I pass away. Well, if I leave the employer, so does that long-term, or so does that life insurance. Long-term care should be portable. So if you do leave the company, because hopefully we're still not working at age 85 years old or 88 when we potentially need this, make sure it's portable so those policies will go with you once you leave your employer. Last but not least, there's I used to not care for these types of policies whatsoever because true long-term care insurance I thought was a lot better way to do it. It was cleaner. You had a lot better benefit. But it's just getting crazy expensive. They're getting the pricing of those policies, unfortunately, are pricing a lot of individuals out. So these hybrid policies, here's how it works, is that you can put some cash into these policies and they have a death benefit and they have a return of premium on it. So let's say I pay my premiums into this long-term care policy, all right? Let's say I don't need the benefit. All right, well, that's cool. So I can get all of my money back if I choose to. I put the money in, maybe it's a single pay, a lump sum, or maybe I'm paying monthly. And then over the next several years, it's like, you know what? I don't want this policy anymore. They'll give me a cash surrender. That's number 3. I can surrender the contract. I can get my money back. It's a return of premium. Or let's say I don't necessarily need to go into a long-term facility or need home health care, respite care, anything like that. I die in a car accident, or I have a massive heart attack. Well, there will be a death benefit associated with that as well. So if I don't go into a facility first, then die, maybe I die of a massive heart attack, well, then that policy will give me a straight death benefit, and that would be, of course, tax-free to the beneficiaries. Number one is that, all right, well, here, I bought this for long-term care. Then that payout will pay when I file that claim. So a lot of different things to consider when it comes to long-term care. I wanted to make this short and simple. I didn't want to get too much into the weeds because, you know, again, this is kind of a dry topic, but I think it's a very important one. If you have any questions at all, please email me. Most of you know my direct email, joe.anderson@purefinancial.com, or you can go to info@purefinancial.com. You want to make sure that you have a plan in place when it comes to long-term care. Any other topics that you want us to talk about, please send it our way. We want to get more information and education out there to you. This long-term care I thought was an important topic. We have several hundred people of you on the line as we speak. I want to thank you all for joining us. Hopefully this was informative. And again, if you have any questions, you know where to find us. Thanks so much, everyone, and have a wonderful rest of your day, and we'll see you again real soon.